Every year, the IRS audits hundreds of thousands of small businesses. And the scary part, most of those business owners had no idea they were doing anything wrong. They weren't criminals, they weren't trying to cheat, they just made mistakes that are completely avoidable once you know what triggers an audit in the first place. In this video, I'm walking you through the 7 most common tax mistakes that small business owners make. The exact errors that wave a red flag at the IRS. Stay until mistake number 5. That one catches even experienced business owners off guard. Quick note before we start. This video is for educational purposes only and does not constitute legal or tax advice. For your specific situation, always consult a qualified CPA or tax attorney. Now, let's get into it. Mistake number 1. Reporting suspiciously round numbers. When real business expenses happen, they're almost never perfectly round numbers. A supply order is $347.82. A software subscription is $49.99. A contractor invoice is $1,250. But when the IRS sees a Schedule C where every single expense is a clean round number, $500 here, $1,000 there, it raises a flag. Round numbers suggest estimation, and estimation means you may not have the actual receipts to back up those deductions. What to do instead? Keep every receipt. Use accounting software like QuickBooks or Wave to record actual transaction amounts, not approximations. The specificity of your numbers is itself a signal that your records are clean. Mistake number 2. Claiming 100% business use of your vehicle. The IRS knows almost no one uses their personal vehicle exclusively for business. When your return shows 100% vehicle use, it immediately invites scrutiny. Unless you have a dedicated business vehicle that never moves for personal purposes, and a mileage log to prove it, claiming full vehicle use is a significant audit risk. The safer play: log your actual business miles using an app like MileIQ, and only deduct the percentage that's genuinely business-related. A realistic 60 to 80% is far less likely to trigger a review than a bold 100. For UK viewers, the same principle applies under HMRC's approved mileage allowance. Overclaiming vehicle use is one of HMRC's most common reasons for opening an inquiry. Mistake number 3. Misclassifying employees as independent contractors. This one has real legal consequences beyond just a tax bill. When you hire someone and pay them as a 1099 contractor, but they work set hours, use your tools, and only work for you, the IRS may reclassify them as an employee. That means you owe back payroll taxes, penalties, and potentially interest going back several years. The IRS uses a multi-factor test. Key questions: do you control how the work is done? Do you provide the tools? Is this person economically dependent on you alone? If most answers are yes, that person is probably an employee, regardless of what your contract says. For UK viewers, HMRC's IR35 rules specifically address this. Contractors operating through a limited company may still be considered employees if the engagement looks like disguised employment. The penalties for non-compliance are steep. Mistake number 4. Deducting personal expenses as business expenses. This is the most common mistake, and also the easiest to accidentally commit. Paying for a family dinner and calling it a client meal. Using a business card for personal groceries. Deducting your home renovation as a home office upgrade. The IRS requires that business deductions be both ordinary and necessary for your trade. Personal expenses that get mixed in, even accidentally, can unravel your entire return. The cleanest protection: never mix personal and business finances. Have a dedicated business bank account and credit card. Run all business expenses through those accounts and nothing else. Your paper trail becomes your defense. Mistake number 5. The big reveal: home office that doesn't qualify. The home office deduction is legitimate and powerful, but it comes with a strict requirement most people overlook. The space must be used regularly and exclusively for business. Not mostly for business, not primarily, exclusively. If your home office is also where you watch Netflix, where the kids do homework, or where you set up a guest bed, it doesn't qualify. The IRS has disallowed this deduction countless times based on exactly that. What does qualify? A dedicated space used only for work. If you meet that standard, you can deduct a proportional share of your rent, utilities, mortgage interest, and insurance, which adds up significantly. For UK viewers, HMRC's homeworking allowance requires the same exclusivity. Claiming a dual-purpose space is a common trigger for inquiries. Mistake number 6. Not reporting all income. Every payment processor, PayPal, Stripe, Square, Venmo for Business, is now required to issue a 1099-K to anyone who receives more than $600 in business transactions in a calendar year. Many business owners haven't adjusted to this threshold drop. If your reported income doesn't match what the IRS already received from third parties, a mismatch notice, or worse, an audit, can follow automatically. The fix: use accounting software that pulls in all payment streams. Reconcile your income at the end of every month, not just at tax time. Surprises in April are almost always the result of ignoring the numbers in June. For UK viewers, making tax digital now requires most sole traders to submit quarterly summaries to HMRC. Underreported income is cross-referenced against bank feeds and payment processor data. Mistake number 7. Filing late, or not filing at all. Of all the mistakes on this list, this one is the most expensive and the most unnecessary. The failure to file penalty is 5% of your unpaid taxes per month, up to 25%. The failure to pay penalty is an additional 0.5% per month. Together, they compound quickly. And not filing doesn't make the IRS forget you exist. It gives them authority to file a substitute return on your behalf, using only the income they know about with no deductions, and send you a bill. If you can't pay what you owe, file anyway. The IRS has installment agreements, offers in compromise, and hardship deferrals. What they don't have is patience for businesses that simply go quiet. So, to recap, the 7 mistakes that put small businesses on the IRS's radar: round number expenses, full vehicle deductions, contractor misclassification, mixing personal and business expenses, improper home office claims, unreported income, and late or missing filings. Every single one of these is avoidable with the right records and the right habits. If you found this useful, subscribe. We cover tax strategy, legal rights, and financial protection for business owners every week. Drop a comment below. Which of these surprised you most?